So you're telling me the stock price went down 20% and yet my put options are also losing money? How is that even possible? I thought buying options would multiply your winnings. But what's going on here? Let me explain. Welcome back, mindful investors. In this video, I'm going to talk about why you'll lose 90% of the time when you buy options. And now demonstrate it through a couple examples and theories. Let's go. So the first example here is NEO. I really thought back in November when everything peaked and every stock in the EV sector jumped like 200% in the month. I thought that was ultimate bubble, so I bet against them. I bought long put options. We look at the long put option, the first one here. We have January 15th, 2021, a $30 put. I bought them when it was like $1.43 per contract. So around this area, November 18th to 19th, that's when I entered the position. Remember this dates, November 18th to 19th. Alright, so if we look at the stock price itself, we go in more detail. Stock price, November 18th to 19th, we'll see what the stock price was at. The stock price was at approximately $47-ish. And right now it's at $41.50. But yet, if we go back to the option that I had there, the $30 put, it has gone down in value since November 18th. It's gone from $1.43 down to $1 right now. So what gives? Well, this whole thing is about the implied volatility of the stock. That's how much the options market expects the stock to swing over time. And how do we calculate that usually? We'll illustrate it through this equation and a couple examples. Right here, it says expected move equals stock price times implied volatility times the square root of the number of days divided by 365. Okay? So we need to define all this with an example. We're going to pick something really stable to quantify this metric. And then we'll look at the NEO example. Alright? So something really stable would be Coca-Cola. There's a really simple way to see how stable the stock is. We just look up the ticker KO. We look at beta. 5-year monthly is 0.57. So what does this mean? It generally compares the stock to the index. So we're saying that if the index moves 1%, this stock tends to move 0.57%. So that's the approximate ratio there. Okay, if we look at the options chain, we'll pick something 6 months out, and then we see that a lot of these calls, they have an implied volatility of about 21%. Right here at $55, $21.68, at $70, $22.75, and so forth. So we use this 22% as the implied volatility. And the stock price right now is at $53, so we have a couple of the metrics there already. Now we jump back to the equation. Expected move equals $53 right now times implied volatility was 22%, so 22%, and then multiply that by the square root of number of calendar days divided by 365, which is about 6 months. 6 months away is half a year, so 183 approximately. Okay, so if we calculate that, 183 divided by 365, and then take the square root, and then multiply by 0.22 times 53 equals 8.26. So the expected move is 8.26. So what does that mean? It means that over the next 6 months, the stock is expected to move $8 up or down, plus or minus. And to fully calculate the expected range, on the lower end, we have 53 minus 8.26, and then the higher range is 53 plus 8.26. Okay, so the range right here will be 44.74 to right here is about 61.26. That is the range for Coca-Cola over the next 6 months. So if Coca-Cola kind of stays within this range, you won't get too much profits out of the options you're buying. The stock price needs to break through this bubble in order for you to be really profitable, like getting the 2x or the 3x. And then we think to ourselves, how likely is that? Well, we can measure that as well through a bell curve in statistics. So the expected move is also known as standard deviation. If we look at the next graph right here, these are standard deviations: -1 + 1, -2 + 2, -3 + 3. And right here, it says how likely things would happen. From the calculations, we had standard deviations equals 8.26, and the stock price right now is at $53. What all this means is that 68.3% of the time, the stock will remain between $44.74 to $61.26. And then for 95.4% of the time, the stock will be between $36.48 to $69.52. Okay, so if the stock goes above and beyond the 2 standard deviations, which is very, very unlikely, which is only 4.6% of the time, then you'll win huge on your long options, either call or put. If it's a call, it's got to break through this $69. If it's put, it's got to break through this $36, 2 standard deviations away. And now we just quantified how likely the case would be. So that was an example for Coca-Cola, where the implied volatility is only 22%. Now, if we look at something like NEO, we see that the beta is 2.88. Again, it means that when the index moves 1%, this stock is expected to move about 3 times that. If we look at the options chain right here, we'll see something really ridiculous. All the implied volatilities are over 100%. Even if we move across different dates to maybe 6 months away, we still have 100+%. So what does that mean? Let's quickly calculate that. All right, the stock is at $42 right now, times 100%, times, let's say for 6 months again, 183 divided by 365 equals 29.74. So the expected range for this stock is $12.26 to $71.74. Again, what this means is that the market expects the stock price to be within this range 68% of the time. $12 to $71. Anything within it is expected. Anything out of it will make you hugely profitable. Okay, so for my January 2021 $30 put is in the red right now for about 40%. I got them at $1.43, now it's only $1. But if we look at my second position right here, we have February 19th, 2021 for $35 put. And this one is in the money. My average price was $3.12, now is at $4.22. I opened both the positions around the same time on November 18th to 19th. But why is this one profitable and that one isn't? It's because of the expiration date and the strike price. This one, the expiration date is a little bit further away, so therefore it gives us more time for it to potentially drop. And the strike price was a little bit higher, therefore this option contract is less aggressive than my other contract there. So after seeing my examples, do you now see why it's so hard to win buying options when you're long the call and long the put? It's because of this equation, the implied volatility, and this bell curve here, and how hard it is to break through these barriers, the upper end and the lower end. Same here, for NEO to tank below $12, that's an absolute crash. The peak for NEO was at $55. If it drops to the $10 range, it's gone down in value for 80%. And then if we look up here to the high range, it's got to go up another $25, which is another 50% over the next couple months. How likely is that? That it will continue for this uptrend like here, when it shot up from $30 to around $55 in November? This type of run is a $25 spike we talked about. How likely is that it will happen again over the next couple months? I don't know. So in conclusion, when you buy a call or put option, your contract doesn't automatically make money, even if it follows what your vision was. If you have a call option and the stock goes up, it doesn't mean that you're making money. The stock has to go above and beyond what the market expects. And same for the put options. The stock has to tank further than what the market expects. Anyways, like and subscribe if you found any value in the video. Thanks for watching, take care, and I'll see you in the next one.